Hi, this is Daniel. You're watching Unrivaled Investing. Recently, one of the top insiders at Berkshire Hathaway made a very large, high conviction bet in Berkshire Hathaway stock, buying Berkshire Hathaway stock for his own account. What's that mean potentially for you? Is now a good time to be buying Berkshire Hathaway stock? A lot of folks this past year, it's been tough investment environment. So folks are looking for a potentially safe stock that still has that potential to return over time. So does Berkshire sort of fit that profile? Let's talk more about Berkshire Hathaway. Who's the insider and what do I think about the stock going forward? Thinking about the valuation framework. So the insider who bought was Greg Abel. He bought $68 million worth of Berkshire Hathaway stock. Now he is set to become the co-CEO of Berkshire Hathaway, running the non-insurance operations, and he was purchasing the A shares around $406,000 per A share. That's the equivalent of around $270 per B share. And so this is, interesting to see him making such a sizable purchase, around $68 million, around $270 per B share. So BRKB versus BRKA, which was trading around $407,000 per share. Now, for context, you might be thinking, well, wait a second, how much is he worth? How big is that purchase relative to, let's say, his income? And over the last 3 years, he was bringing in around $19 million. So relative to his income, that's very sizable purchase, around 3.5 years worth of time. But arguably, he's working because he enjoys the game at Berkshire, because more recently, he actually sold his minority interest in Berkshire Hathaway Energy back to Berkshire Hathaway for $870 million. So he has no shortage of cash over here. But it is still his way of sort of saying, okay, I'm selling this business that I, helped grow to Berkshire Hathaway, this 1% stake that they didn't own, selling it for hundreds of millions of dollars. But I do think this is effectively what he's doing based on this action. He's sort of saying, I do think that Berkshire is a high conviction bet. Now, he's not putting all of that money in, but he is putting in, 60, a sizable amount of money into Berkshire Hathaway, sort of saying this is a conviction bet. And I'm curious to see if he buys more over time. Now, it's interesting to see that he's also buying at a discount to Warren Buffett, who at the end of the fourth quarter last year was buying back literally billions of dollars of stock, around $280 per B share, around $440,000 per A share. So sizable purchasing from Buffett to buy back stock. So Buffett's effectively saying, hey, this is a value that I think is good. This is below fair value. Stock's currently below that. So this should get investors enticed. If you have one of the greatest investors in the world, like Warren Buffett, say, hey, I think my stock's cheap here, and then it goes below here, and then you also see insiders buying below there, that is a lot of favorable data points suggesting, hey, Berkshire Hathaway could have sizable upside from here and is also quite possibly at a very fair value. When you look at it on a price to book value basis, you could see that it trades, sort of in line with where it's been over the past decade. Buffett has gone from saying, hey, I would buy at 1.1 times book to 1.2 to sort of say, hey, I'll buy below intrinsic value. And so it sort of seems like now around 1.3, 1.4 times is probably around book. I personally, instead of using book value as the metric, I look at what's sort of the potential earnings power from Berkshire Hathaway and sort of think about that as a multiple and looking at that as a business. So we'll talk about that earnings power in a second. So how do you think about, what Berkshire could earn over time? Well, you have so many different business drivers here. You have, their various different insurance operations. And so far in 2022, their auto insurance has been underperforming, generating sizable losses as driving behavior post-COVID has just been awful. And so you've seen sizable losses. Historically was generating, $3 billion plus in profit, or it could. And you see, what their various different insurance operations are generating. You have investment income, which is dividends plus interest from their sizable cash portfolio. Then they have Burlington Northern Santa Fe, one of the largest rail systems in the US. You have Berkshire Hathaway Electricity. You have manufacturing segments. Manufacturing is one of the largest components. You have McLean, which is transportation, and service and retailing. So all in, during the first half of the year, generating around 18 billion in pre-tax profits. So very sizable component. The next key component is looking at their investment portfolio, which, mark to market lost $70 billion in value during the first half of 2022. So when you're thinking about valuing Berkshire, you want to look at, hey, what's the earning power of the underlying business? And then the next component is the portfolio. When you think about the portfolio, it's currently around 300 billion plus in various different stocks, then around 125 billion in cash and equivalents fixed maturity securities. So thinking, hey, what are you getting from your cash, and what can their stock portfolio do over time? That's really what's driving that second component. Okay, so what do I think about Berkshire Hathaway stock from here? Where do I think it goes? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. And full disclosure, this is not financial advice. And so when you're thinking about these two different components, their portfolio and their underlying operations, so a $300 billion stock portfolio, if you think management can deliver, if you think Buffett and his, lieutenants, Todd Combs and Ted Weschler, can generate attractive returns over time, I'm penciling out 5 to 7% after-tax returns. Maybe it's better than that. That said, it's hard to really drive a multi-$100 billion portfolio, most of which is concentrated in just a couple of names. I mean, Apple's about 40% of that portfolio. Bank of America is 10%. You have another, let's say, 15% in oil bets that include, Chevron and other plays. And so you're looking at this sort of saying, hey, a fairly concentrated portfolio, as a lot of top investors do. And can this generate, let's say, 5 to 7% after-tax returns over time? If so, if you think they can, then you're talking about potentially 20 billion in earnings power from their investment portfolio over time as it sort of compounds in value. Now, I personally have some, I'm a little skeptical about where Apple shakes out over the next few years, partly because, the valuation has expanded quite a bit. That said, there is sizable buybacks. So we'll see, but that is about 40% of their portfolio. So that could be a headwind, for them in the years ahead if they don't dramatically, let's say, reaccelerate revenue growth or the valuation compresses. If that were to happen, that could be a challenge for part of the portfolio. But thinking long-term, maybe 5 to 7% after-tax growth, we will see. And then looking at the next key component, which is pretty much their non-insurance operations, and you see, their non-investment portfolio, and you're looking at around 30 billion in earnings power. At least it was 32 billion pre-tax in 2021, but that includes around 5.6 billion from their investment float in terms of investment income. Now, this is primarily dividends, very little actually from their cash. And so they are, I frequently talk about, you want to invest in things that are benefiting from the environment. And so in a rising interest rate environment, this does benefit Berkshire in the sense that, hey, they have 100 billion plus in cash. They're now going to get a higher yield from that. Now, in past years, it was generating like 500 million in interest from their significant cash portfolio. Now that might be generating $3-4 billion. So when I think about the earnings power of the business, not talking about the stock portfolio, I think you could probably talk about around $30 billion after tax when you consider the fact that they're benefiting from higher interest rates. And overall, they own a bunch of unrivaled businesses that have steady earnings growth potential over time. And you've seen that growth over time as they've grown from 39 to 32. You might see mid-single digit growth, maybe higher for this business over time. So I'm penciling out around 30 billion in after-tax earnings power for this, for these two. So when you think about, the combination of their portfolio, which might grow at, let's say, $20 billion a year, and their underlying businesses and the earnings power from them, generating around 30, so 20, 30, around 50 billion, give or take, in earnings power, normalized earnings for Berkshire Hathaway. And so I use that as sort of a starting point, thinking about where do I think Berkshire goes from here? And this is, I think, part of the reason why Warren Buffett is buying or has bought back stock at even higher prices. You see Greg Abel making this high conviction bet is, 50, if you're generating, let's say $50 billion and the current market cap is 617 billion, which is based on a Berkshire B share at 280, that implies a low teens earnings multiple. So this gives very little credit to the quality of Berkshire Hathaway and potential growth in the years ahead. I mean, if you have organic growth of, let's say, 6 to 10% in the years ahead, and it stays at a similar multiple, or similar, or maybe you get some sort of multiple improvement to 14 or 16 times, then you're potentially looking at maybe 100% upside over the next 5 years, depending on the organic growth of their businesses. And then you factor in, well, wait a second, they still generating meaningful amounts of cash that they can use to either accelerate their growth or buy back stock. So I'm assuming organic growth of 6 to 10%. So that means without acquisitions. So looking at their cash flows, maybe that's 20, 30 billion in actual free cash flow that's being generated relative to their $600 billion market cap. And so that's an additional, let's say, 4 to 5% a year that can be accruing to shareholders, either through acquisitions or through repurchases. And so that's how I'm penciling out potentially high single-digit return over the next 5 years, maybe even high teens, maybe close to 20% annualized return over the next 5 years. Now, keep in mind, this is a hypothetical valuation framework for Berkshire Hathaway. A lot depends on, the execution. If their stock portfolio, let's say, does come under pressure, which is one of the concerns I have about Apple being one of the top holdings, then obviously, the stock price wouldn't do as well. It all depends on the execution. If they do really well, wouldn't surprise me to see stock price do way better than what I'm penciling out. But if things aren't as good, stock price could underperform. That's why it's a hypothetical framework. But overall, I look at Berkshire Hathaway and I think relative to a lot of investments out there, you have the cash flow, you're benefiting from this environment. They can deploy capital when there's bargains available, which is what I want to see. I want to see these anti-fragile businesses that can pounce on bargains in a tough environment. So I like, where Berkshire Hathaway is. I personally don't own it, but I could certainly understand why Greg Abel was buying it, sort of saying, hey, this is certainly going to do better than cash over time. There's a good chance, and I personally suspect that it will outperform the S&P 500 over, let's say, the next 5 to 10 years. So if you enjoyed this video sort of framing why Greg Abel was buying and what I personally think of Berkshire Hathaway stock going forward, please make a point of hitting that thumbs up, hit that subscribe button. Thank you for watching Unrivaled Investing.